I want to welcome you to this edition of the video cast for cost accounting, and this one's going to talk about cost behavior. Now, cost behavior is one of those we're going to try to predict what cost will do based on the production level, and that's what we're trying to do. And with that, we have different drivers. We have unit level drivers, which examples of that would be direct labor hours, direct labor costs, machine hours, and what we call a traditional type of cost drivers. And then we also have non-unit level drivers, which are number of setups, work orders, how much material moves we have, that type of thing. We'll get into that probably later. We have two types of costs that we're going to deal with mainly. There are other types, but we have to break them down to these two. One is variable costs. Now, there are two characteristics of a variable cost, and these are important. Total cost changes with production. And it's going to be very specific. You have to have total cost changes because there's another type of cost we're going to be talking about, and that's the cost per unit. For variable costs, the cost per unit is constant, but the total changes with production. So as production increases, the total variable cost will increase, but the cost per unit stays the same. And then we have fixed costs here. Now, fixed costs just the opposite. The total cost is what stays the same over the relevant range. So if your production capacity is 10,000 units, from maybe 1,000 units to 10,000 units, we have the same fixed costs. Okay, it doesn't matter whether you produce 1,000 units or 10,000 units, the fixed cost is the same. But the cost per unit is inversely related to production. What that simply means is that as production increases, the cost per unit will decrease. And these two concepts will come back later in the course. And then overhead is what we're going to be talking about in this chapter. Overhead is any costs incurred that's for manufacturing, not direct materials or direct labor. Direct materials and direct labor are basically considered direct costs. Overhead is everything else, but it has to be related to manufacturing. So if it's cost for the office administration then that's not a manufacturing cost, that's not an overhead cost. It has to be the supervisor for this plant would be an overhead cost. So it has to deal with overhead, with manufacturing process is what it deals with. Of course, the selling price must cover all direct and indirect costs. Then we have activity capacity. This is resources required by the firm. Okay, that's acquired by the firm, such as labor, equipment, buildings, that type of thing. So it's what your capacity is. Practical capacity is resources used efficiently. Unused capacity, of course, are resources that you have that not being utilized. It may be part of the building's empty. That would be unused capacity. It could be some equipment that's not being fully utilized all the time. That's unused capacity. Okay. Types of resources. We have flexible and committed. Flexible resources, you purchase those when you need them and use them. Okay, so when you need them, you purchase them and use them when you need them. Committed resources are ones that you may have purchased ahead of time. You have to have them, or you have a contract for them. You're required to purchase 5,000 tons every 2 months. Well, that's a committed resource. It doesn't matter whether you need that 5,000 pounds or tons or not, you're committed to using it. Also, equipment or buildings are committed resources. You have them, they're committed. Doesn't mean you use them, but they're committed. Okay, you can't do anything about it. Now, the other types of costs we have are mixed costs. Mixed costs both have elements of fixed and variable in them. And there are two basic types that we talk about, step variable and step fixed. Step variable has very small increments that it goes up. Okay, fixed components is very narrow steps. And or the other one, you may have a fixed charge, and then it goes up from there, such as your electric bill. If you don't use any electric whatsoever, you still have a fixed charge, a fixed expense for it because you're hooked up. Now, step costs are ones that have a little wider relevant range, but not wide enough. I guess you look at it, all fixed costs are step, but some are bigger, larger than others. Like the one I said, 1,000 to 10,000 units, that's a step cost, but that's considered fixed. So if it's a smaller fixed cost, though, such as one supervisor for every 10 employees, it's considered a mixed cost, but it has a fairly narrow relevant range, but wider than the step variable. Okay. Two ways of doing it: actual costing and normal costing. Actual costing we won't be doing because that actually uses costs. The problem you have with actual costing is that it deals with overhead is seasonal sometimes. And you have to know what the actual cost is. So it's going to vary from month to month. For instance, how much heat do you need in July? Or how much air conditioning do you need in January? In some parts of the country, you don't need any. So that's actual costing. So we really can't use actual costing. What we use is what they call normal costing. On normal costing, you use actual direct material costs and direct labor costs, but overhead is based on a predetermined overhead rate. Okay, so you estimate overhead, and then you estimate what the overhead is going to be for the year, you estimate what your activity level is going to be, and then you come up with a rate, and you use that, and we'll get that a little bit later. Here's the reason for a predetermined overhead rate. It can be assigned to goods and services during the production. If you use actual, you have to wait to the end of the year to actually assign them, and customers won't do that. Overhead rate adjusts for variations in actual overhead seasonal, so you estimate what's going to be fluctuation activities, and you'd be aware of. Okay, there's some of the profitability a little bit faster. Okay, formula for the overhead. Overhead rate, as I probably should highlight that. That's the total estimated overhead divided by your total activity level, and that's the total estimated activity level. So activity level can be direct labor hours, direct labor costs, machine hours, total units for the year, whatever you may be. And then you take that rate, and this is the rest of the formula. You take the rate times the actual activity level, and that gives you applied overhead. And then this is the formula that you would use for the applied overhead. You debit work in process, and you credit factory overhead. That's factory overhead. That's the applied overhead. That's whatever this number is right there that you come up with, the applied overhead. This journal entry is for actual overhead. Now, you don't have an account called various accounts. The reason why we put various accounts in here is because it could be cash, supplies, raw materials, labor. It can be a lot of different things. And that's why we don't accumulate a depreciation, so we don't actually know what it's going to be. But so we just use various accounts for the class, or use whatever they could say, just cash, inventory, etc. Okay, these are little things I have. The applied overhead. If actual factory overhead is greater than the applied overhead, it's underapplied. If actual factory overhead is less than applied, it's overapplied. If actual production is greater than expected production, it'll be overapplied. If actual production is less than expected production, it'll be underapplied. Okay, and our main adjustment is going to be through cost of goods sold. If overhead is underapplied, cost of goods sold is too low, so it'll be raised. If it's overapplied, I forgot to put overapplied in there, is if overhead is overhead. Now that makes sense. Let's say overapplied, then it will be cost of goods sold is too high, so we need to lower it. So your basic journal entry is cost of goods sold is a debit, factory overhead is a credit. And this is if it's underapplied, because we need to increase the cost of goods sold. Okay, so here's an example. Applied factory overhead is $210,000 and $190,000 for the underapplied. Okay, it's two different examples. Actual variable overhead, it was $200,000 for both. So the difference here is it's $10,000 overapplied, and on the other one it's $10,000 underapplied. Well, for the overapplied, the cost of goods sold is too high, so we need to reduce it. So that is, we reduce it by the $10,000. So we would debit the variable factory overhead and credit cost of goods sold for the $10,000. And over here, we do just the opposite because it's underapplied. So the cost of goods sold needs to be increased by $10,000. and the variable factory overhead decreased by $10,000. Okay. Ways we measure activity level. You have theoretical capacity, practical capacity, normal capacity, and expected capacity. Theoretical capacity is what you could make if everything runs 100% efficiency and no holidays or downtime, idle time, or anything else, no sick time. Practical capacity allows for setups, holidays, and breakdowns. Normal capacity is what you've been averaging for the last 5 to 10 years, and expected capacity is what you expect to do for the next project production, for the next production period. Okay. These two are probably the most common ones. Well, some people use practical also, but these two will pretty much always be under applied because it's hard to reach those. These can go either way. Okay, methods to allocate mixed costs into variable costs. I think we'll stop there and start on the next one for this. This is where we start doing some calculations. So I will stop on this one. That's just the terminology part, and we're going to do methods on the next video.